When massive companies collapse or life-defining investments vanish overnight, the root cause is rarely a lack of information. The failure almost always comes down to relying on flawed human intuition while navigating environments that are entirely unpredictable. To fix that flaw, we first have to recognize that every choice you make exists inside one of three specific environments. You are either making a decision under certainty, under risk, or under uncertainty. Certainty means you know the exact consequences of every option. Risk means you don't know the exact outcome, but you have the precise mathematical probabilities of each possibility. In high-stakes reality, both of these are surprisingly rare. That leaves us with uncertainty. This is the most dangerous environment. Under true uncertainty, you might know the possible outcomes, but you have absolutely zero data on the probability of any of them actually happening. When you try to navigate an uncertain environment with a standard pros and cons list, the process breaks down. Your choices get skewed by whatever happened to you most recently, your current emotional state, or a paralyzing fear of making the wrong move. The true danger in high-stakes strategy is not the unpredictable future itself. It is using an emotional mental model to face that future, which exposes you to completely uncalculated ruin. The specific antidote to that emotional bias and analysis paralysis is the use of quantitative decision-making models. There is a major misconception about these tools. Mathematical models are not designed to predict the future. They exist strictly to align your choices with measurable data and your own personal tolerance for risk. The foundational step of this process requires mapping out a systematic branching of every possible alternative and outcome before you take any action. The primary tool used to organize this analysis is called a payoff table. A payoff table is a grid that visualizes your potential financial gains or losses. The table is structured by pitting your decisions, the specific actions you control, against the states of nature, which are the external conditions you absolutely cannot control. By forcing your dilemma into a payoff table, you systematically strip emotion from the process. You compel yourself to confront the raw math of your available choices. Let's apply this to a real-world dilemma. An investor must choose between three distinct paths for their capital without knowing how the volatile market will behave next year. They have three specific alternatives available: buying governmental bonds, investing in the stock market, or investing in mutual funds. They also face three completely unknown states of nature. The market could be favorable, normal, or unfavorable. This chart shows how abstract decision theory structures this exact problem by mapping the decisions, labeled D1, D2, and D3, against those states of nature, labeled S1, S2, and S3. When we translate that abstract matrix into our specific investment numbers, we see the vast differences in potential financial outcomes depending on the market's behavior. Bonds range from a $100 gain to a $20 loss. Stocks swing violently from $200 to a $30 loss. Mutual funds range from $0 to $100. This raw data proves that there is no universal best choice in a vacuum. The data remains completely neutral until a human applies a specific behavioral framework to it. We can evaluate this table using one of two extreme behavioral frameworks. The first is Maxi-Max, an aggressively optimistic approach. The core mechanism of Maxi-Max is straightforward. The decision-maker strictly isolates the absolute maximum possible payoff across all available options. Under the Maxi-Max rule, the definitive choice is decision B, stocks, to capture that $200 ceiling. But this framework has a severe blind spot. To chase that maximum reward, the decision-maker must completely ignore the downside risk. Maxi-Max is a mathematical gamble. It prioritizes the highest possible ceiling at the total expense of a safety net, exposing the user to maximum potential loss if the market turns unfavorable. On the other end of the spectrum is Maxi-Min, the highly conservative, pessimistic approach to the exact same data. The Maxi-Min mechanism works in reverse. The decision-maker first scans the table to isolate the absolute worst possible outcome for every single choice. Then they choose the best of those worst-case scenarios, seeking the maximum of the minimums. In this case, mutual funds went out. The trade-off of this strategy is steep. By choosing mutual funds, you guarantee zero loss of capital, but you entirely abandon the chance to make significant high-end gains. Maxi-Min eliminates downside ruin, but sacrifices exponential growth. It is a framework designed exclusively for survival, not victory. Choosing between Maxi-Max and Maxi-Min is not a math problem. It is an alignment problem based entirely on your operational reality. Choosing a mathematical strategy that is completely misaligned with your own real-world profile will inevitably lead to sudden catastrophe. For a fragile entity, like a low-margin small business, using the Maxi-Max framework means a single unfavorable state of nature will cause total bankruptcy. To solve this, we introduce a mapping system to match profiles to the correct mathematical model based on risk tolerance and growth needs. We plot an aggressive optimizer, like a venture capital firm, into the high-risk, high-growth quadrant, matching them perfectly with the Maxi-Max framework. If you possess the capital runway or the time to absorb heavy losses, Maxi-Max is not reckless. It is the mathematically correct choice to break out of stagnation. Conversely, we plot a defensive strategist, like a retiree or a defensive business, into the low-risk and capital preservation quadrant, matching them with the Maxi-Min framework. For these individuals, the aggressive pursuit of maximum optimization will destroy their baseline survival. The math inside a payoff table does not dictate the future. Instead, it forces you to acknowledge your true capacity for ruin. A good decision is not a choice that pans out by sheer luck. It is based on a rigorous, systematic evaluation of alternatives. Relying on a systematic approach protects you from regret, allowing you to act decisively even when staring down the unknown. True strategic power isn't the ability to predict the future. It is the discipline to align your actions so perfectly with your risk tolerance that you can survive whatever the market does next.